and welcome. Thanks. I want to start, for those that haven't had the chance to be familiar with KBC, with what is KBC, talk a little bit about the strategy, about the competitors and the market, about the financials and the targets, and about the leadership. So what is KBC? 35-year-old company, always been profitable. Two parts. One, technically based consultancy to assist oil and gas companies improving their profits and de-risking their operations, and that's 70% of the business currently. And the second, a developer and seller of simulation software used to optimize those assets. Those two parts are heavily interconnected, so it's best to think of the company as having the two parts, but strongly interconnected. 340 people worldwide, 18 offices spread throughout the world, the sort of places you would expect for an oil and gas service company. Main hubs, Houston, London, and the axis of Singapore and Kuala Lumpur. The strategy. Three key parts to our strategy at this point in our history. Expand the technology faster than consulting. The objective is to go from 70-30 consulting to software, which is part of the technology division, to 50-50 over a period of time. We haven't declared exactly, but I would say 2018-19 is a good estimate. Second part of the strategy is to create an upstream business equivalent to the downstream profit improvement business that we built over 35 years. An expansion of the upstream in a manner that requires us significant both acquisitions and development. And the third is to turn around a consulting business that financially and some other ways have been mediocrely run, really. We're halfway through a 3-year program of improving the basic consulting offer that we provide our clients. Competitors on the software side, Aspen Tech, Honeywell, Inventus, plus a tail, a very significant tail of small companies. We've bought two ourselves recently, one in 2012 and one in May of this year. So a slew of software competitors, some large, some small. We're probably in the middle. And then on the consulting side, the biggest competitor, you might say, is our own clients, because we're working at the core of their actual oil and gas operations. So we're not teaching them about IT or finance or human resources. We're teaching them about how the assets, their own operating assets, can be improved and how to get profit out of them. And this is a capital-intensive industry with high risk, so that requires quite significant skill and quite significant patience to be able to convince them to give us those assignments. So those are the competitors and the markets that we offer in. About $1 billion served market for us. And the financial targets that we have are clearly 9% margins in consulting. When I took over this executive role, we had margins hovering between 0 and 2%, some loss-making halves. And we're on a journey to 9%. This is not going to happen immediately. The first half, as we'll talk about later, we've reached 5% on that journey. And 9% is an appropriate 9-10% margins for this consulting. The software, which is much higher margin in the region of 30%, by growth and by the strategy of moving that as part of our revenue, will naturally uplift our mix from an overall 13% margin to 20% margin over time. And then finally, as an introduction, the leadership. There'll be a new CEO in place by May 2015. We have internal candidates, and we're hiring a few extra senior leaders. We know where the gaps are. We're filling them in as we expand the business and strengthen the leadership. So those are the summary, really, of what we are and what we're about at the moment. If we look at the first half of 2014 results, the revenues are up by 9%. The profit on the surface looks to be flat versus last year, 2.9 versus 2.9, but the underlying profit is better thought of as 3.6 versus 2.2 last year. There's foreign exchange movements of 0.7 positive last year and 0.7 negative this year in the first half results. On average, over a year, we typically only have maybe 200,000 losses or gains from foreign exchange. We're naturally hedged at about 70%. 30% is exposed. The loss that we made from foreign exchange this first half, a lot of that has been reversed already since the dollar peaked in June at 1.7 back down to 1.64. So we're confident that the first half is not representative of what will happen for the full year. As last year, it was the same case where 0.7 became 0.1 at the end of the year. So a better way of looking at the first half is 3.6 versus 2.2. Earnings per share diluted, of course, for two reasons. One, because of the equity raising, and the second, we had a one-off tax credit last year as a result of some heavy work in 2013 to recover some tax that was due us, but we weren't structured correctly for it. Net cash at the half year, 24.4 versus 6.9. Contract awards are down on the first half of last year. All of that down is relating to the delivery, very successful delivery, I have to say, of our largest ever contract in Latin America, a $100 million contract, mainly for consulting, but had software in it. We have used up 20 million pounds of that contract over the last year, and we have replaced quite a lot of business, but we haven't fully replaced that. We're not at all concerned about that because we're de-emphasizing consulting as a part of our portfolio, and we're focusing on profit and margin rather than sales increase. And in any case, we have a very strong pipeline that we're facing well over the sorts of levels that I've seen, certainly in my 4 years in this in the chairmanship, in the role on the board. The three areas that we're very confident of in seeing substantial business: Middle East, where we were very small until very recently. We've invested in new people, and the wall of business that is facing us there is actually quite daunting. A very significant win for us in Kuwait recently, last week. First time we've been working in Kuwait for 7 years. We're working in Aramco in Saudi Arabia, and substantial opportunities there of multi-million dollar contracts. Latin America continues to be a very strong market for us. Peru prospects, Colombia, and Mexico to go alongside our Ecuador, and of course we were very strong in Brazil at one time. We're coming back into that market. And then the third area, parts of Asia, particularly Malaysia, Thailand, one or two other parts, and some new prospects, of course, in opening areas such as Myanmar. So a very strong pipeline that we're facing in the future. What I'd like to do now is hand over to Andy Howell, Managing Director of the Technology Division, for him to not only talk about technology, but also give a little update on the consulting business. So, Andy.
Thanks, Ian. I'd like to add my welcome to the webinar as well. Just a few moments take a few moments to talk about the two businesses, technology and consulting, and the synergy between them. Technology, software, had a strong H1, down on H1 of the previous year, but 2013 was a record year, and it was always going to be difficult to achieve that. A large number of contracts came in early in 2013, and typically we're back-end loaded as a business. But very solid performance, 8.4 million, so it's the second best performance in KBC's history for an H1 in technology. Included a number of very strong Petrosim renewals and expansions, and in particular in H1, one of our Latin American clients not in Ecuador, came through with a $5.2 million deal. Total half-year rewards are $9.2 million, again close to a record. Very pleased with that. PetroSim 6. PetroSim is our flag simulator. We're going to talk flagship simulator. We're going to talk a little bit about that in a few moments with the acquisitions in respect of those. PetroSim has been going from strength to strength, and we're on target for release in version 6 in Q4 of this year. And version 6 is a very significant release for the upstream industry, which we'll mention in a few moments. One very good figure we're very pleased with is our corporate strategy of improving the quality of our earnings long term is coming through with recurring revenue from software now at 51% of the total backlog of KBC, up from 43% of the year before. And following on from a solid H1, we've had a very good start to H2. We reported a second Latin American software contract, also not in Ecuador, totaling $5.7 million in July, in fact 15 days into H2. Another strong commitment from an existing customer and an expansion of our software technology and services with those. And that now puts us in a very good position for our target for the year. We just move on to highlights from the consulting division. Consulting had an excellent first half of the year, as reported by Ian a few moments ago. Record revenue at $26 million, reflecting both the drawdown on the Ecuador job and a number of new projects. In particular, the focus that the management's had on the control of pricing, utilization, and leverage really starting to show through. Our focus is not revenue, our focus is margin, and we've actually we've grown both in the first half of the year, which is very good. But the focus on margin, we've moved profitability for the consulting division into around about 5%, from 3% full year in 2013 and 0 in comparison with the first half of 2013. So first and foremost, higher margin, 5% from consulting, and indeed higher revenue along with that. So an excellent performance from the consulting division. In particular, the 4-year $100 million Petro-Ecuador project is going extremely well. We've proved to ourselves as well as the industry that KBC is mature enough now to deliver a $100 million consulting and technology project. And that's reached its milestones, the customer is happy, and we're starting to see benefits flow through from that project, indeed affecting the whole country of Ecuador and their production of diesel and gasoline. And as Ian's mentioned a few moments ago, the consulting pipeline is very strong, one of the largest we've seen, driven by, again, very strong prospects in the Middle East, South America, and Asia. Just for a few moments now, I want to focus on the FEESA acquisition. So the placing that we put forward and successfully concluded in May aimed at raising funds to go after a number of technology acquisitions. During that placing, we did state that we had one that we had close and were keen to close, and we did that on the 21st of July. A UK company called FEESA. They're an upstream technology and consulting company, culturally very, very similar to us, and in fact located very close to us in Farnborough. We paid $11.2 million, with $1 million of that in paper and shares. It's not an earn-out. We fundamentally don't believe in earn-outs. They don't drive the right behavior long-term for a company of our size in the technology and service business. And so we try to avoid them if we can and successfully integrate those offerings as quick as we can. The leverage of the acquisition is the synergy with PetroSim and our own consulting services. One and key thing that acquisition has enabled us to do now is focus on the full hydrocarbon value chain from a simulation perspective. In refining, we've been for a long time able to model the entire refinery and then build our services on top of that and deliver full optimization programs for refining. In upstream, we've been able to do the facilities part of it, which is the equipment on the top of the oil rig or in the gas plant, but not the flow lines, not the pipelines on the seabed or the well infrastructure that connects back to the reservoir. And really, you can only do half a job, or perhaps less than half a job, of optimizing an upstream asset for an oil company if you can't do the pipelines and the wells and the connectivity back to the reservoir. And that's what we've now achieved, firstly with the Infochem acquisition, the reservoir chemistry acquisition of 2012, which gave us access to the oilfield service companies as clients. And then secondly, with FEESA now connecting the Infochem technology to us through pipelines to Petrosen. FEESA also came along with some 15 or so industry worldwide experts in pipeline engineering flow assurance. And we've got a very strong reaction from the market, from FEESA's customers and our own, to the big picture that they can now see that we're putting together. Petrosim 6, we mentioned a few moments ago, will release with the Maximus pipeline wellbore simulator contained within it. The integration both from a corporate level and from a technology level is progressing very well, and we've had some practice with acquisitions, and we'd like to think that we're getting much better at it and very efficient at it these days. Long list of opportunities growing. We've closed some business already on the consulting side that FEESA would not have done by themselves from KBC's weight in the marketplace. And we're looking forward to introducing FEESA to more of an international market. They're based in the UK and Perth, Western Australia, with no operations in Houston, South America, or KL. And obviously we're going to exploit that international set of international channels with their technology and ours combined. And finally, we set ourselves an internal target, a projection for the FEESA business, and we fully expect to achieve that during the rest of this financial year. And with that, I'll hand it back to Ian for a few detailed comments on the numbers. Ian.
Just a quick highlighting of the income statement. I'm only going to say a couple of things about this because it's fairly straightforward. We are on track for the full year. The half year, first half has always been smaller, or mostly been smaller than the full year, and that's the anticipation again this time. Our tax rate, which was high and still remains high, and we're working hard on it, was 42%. We've reduced that to 39%. But we also had a major tax credit in the first half of 2013, which distorts, of course, the comparison. So it's not a like for like as you look across that. And just to repeat, really, we are on track for the year's expectations. On cash flow, we've had some increase in working capital relating to our Latin American contract that's been referred to, the big one, and that has caused, particularly at the half year, some perturbations around the cash flow. There's about 4 million of work in progress, and there's 3 million of invoicing that wasn't paid till the 4th of July, which is slightly disappointing for the half-year results, but over the final year, the finance group are confident that those will be recovered. The other thing to mention is that we've, of course, paid back our debt, the £3 million of debt, and have therefore refinanced and changed the balance sheet, which is an attractive feature of what we've done with the equity so far. So I would say I hope that they're fairly straightforward to understand and track. So I go back to summarizing. Good progress against the group strategy, the three things I mentioned: shift to software, move into upstream, and consulting better managed. Strong operational financial performance for the first half, on track in the 3-year program of success. Leadership succession I've mentioned, consulting revenues up and margins up, technology performance fine, profit before tax first half 3.6 versus 2.2 when you adjust for the foreign exchange. The successful placing in May of 23 million net. The acquisition, the first of those acquisitions that we promised the market for 10 million cash, 1.2 in equity, and the FEESA, which is Andy's already described. Second half started well, especially in technology, so we're very confident for the future.
Gentlemen, thank you very much. We shall move quickly on to questions. A couple to get you started from Simon. Is the sales pipeline greater than 50, 100 or 150 million?
It's greater than 150 million. Straightforward. Some of the things I've mentioned already, Middle East, Latin America and Asia, gives it a big outlook.
Lovely. And why is the pace of adoption for petrosim production so slow in the mid and upstream? And when will it reach a tipping point?
That's a good question. So far, it's taken us 30 years to get to where we are in refining. We definitely don't want it for it to take that long. We're looking at a 2 to 3 year horizon to really break into upstream, particularly from a technology perspective. The upstream oil and gas business is a very conservative business. We know that. The technology life cycle adoption is 2 to 5 years with existing customers, etc. And obviously the pace of field development, fields get found and then explored and developed, and sometimes that cycle's 3 to 5 to maybe 7 or 8 years in maximum. So it's a conservative industry, you've got to build it. The second point is you have to have a key differentiator in that business. And the petrosim technology that we inherited from downstream didn't have that differentiator 2 to 3 years ago. In buying Infochem and buying FEESA, we now have a clear differentiator over our competitors. And it's really about launching Petrosim 6. It's about the marketing and sales and execution of all of that, building on the install base of both Infochem and FEESA. So tipping point, I would say maybe 1 year, 18 months, 2 years. Depends on 2 or 3 large contracts, which we currently got in discussion with operators.
Thank you. It would like to know if there is much risk to upstream investment from a further downward correction in the crude oil price.
Yeah, I mean, we were anticipating a year ago. I sit on Bristol's group, the helicopter company in Houston, so we've got many perspectives on this. And it's clear that a year ago, certainly at the Houston OTC that Andy and I were at, that they were talking about a downturn taking place, that it had peaked in terms of capital investment, and that it would probably be a 3-4 year cyclical downturn, caused partly by the oil price drop, which was predicted by some, not by everyone. And the effects on the industry are that things are getting squeezed. Now, for us, that's actually very positive, usually, because when it squeezes the industry of that nature, and certainly in the upstream, that means that profit improvement comes racing into the fore. So for us, this is probably a boost for us rather than the opposite. But for those heavily involved with capital and engineering contracts and future the field development up front, they can feel the effects of that. We believe that there is a cyclical downturn in the investment cycles, going particularly into deep offshore. But there's still plenty of business. We are personally, we are so small that wouldn't put us off in any way.
Thank you. John would like to know if the 21% EBITA margin for the technology arm is sustainable.
No, it needs to increase. Absolutely.
Definitely.
We've put some heavy engineering into Petrosim 5, Petrosim 6, a lot of our energy technology integrated. We're bringing out a new version of multi-flash, the Infochem technology. It'll be the first time that has a much higher addressable market in terms of actually approaching reservoir engineers with the production PVT. So bringing those acquisitions in, we've had to overinvest in getting the shape of that right. And now is absolutely the time to do it, as well as a lot of effort and heavy lifting on quality engineering, quality assurance in the software. We come from a consulting company background, and in the last 3 years we put a lot of effort into product lifecycle management processes, R&D processes, and quality and testing. Because when you're selling $5, $6, $7 million contracts to large integrated oilfield service companies and oil companies, you've got to be top quality. With some of our biggest competitors, that investment will pay dividends in the future, and we expect the margin to go up automatically.
Thank you. Daniel has got a question around payment days. When you work with the large government-owned companies in developing markets, how do you ensure you get paid in a timely manner? He's recalling the difficulty you had getting paid by Pemex.
With great pain and difficulty is the answer. I'm afraid I'm a realist, as you know. I'm a kind of Scottish realist about these things. No matter what you write into the contracts, especially if they're $100 million contracts, you haven't got a company our size. We haven't got much leverage with those. On average, and in fact, vast majority of our companies pay. It's a question of the timing. The only risk we really have is sanctioning, which happened to us in Iran, but those happen very rarely. In the case of the large contract, they have, the client has appointed a supervisor to look at all our invoicing, all our work streams, etc. And so the answer to your question, I'm afraid, is we have a finance team that works as hard as it can to reduce the number of days, and those that have been around the world for a while would like to think it was otherwise. Now, we have a team that I think over the last 3 years has improved, particularly on the international front with improving that. But obviously, at the half year, you can see some of the effects of late payments, as it were. It happened to be about 2 weeks, but that made a big difference in terms of our half-year results. The industry, I've talked to my colleagues and Bristol's and so on. We all face the same basic problems, as you can't negotiate very hard. The 3 largest oil companies in the world are national oil companies. That's Saudi Arabia with Aramco, it's Gazprom in Russia, and it is NIOC in Iran. Exxon comes fourth. You know, if you're ambitious in the oil company, you cannot ignore the national oil companies. These are the 3 of the largest of the top 4.
Thank you. Final question on the FEESA acquisition, which looks to be an excellent fit with Infochem. Was there much historical contact between the 2 firms previously?
Yeah, it's a very good question. It was one of the things that attracted us to them. First and foremost, they're both London Imperial College spin-outs. So their academic history is strong, and KBC we like that kind of acquisition. Secondly, the Maximus simulator, which is well bores and pipelines, needs chemistry, it needs fluids information, and have been using the Infochem multi-flash simulator for its 10 years of existence. And in fact, it was one of the better implementations of the Infochem simulator. And so there were no negotiations with any third parties about what was contained in it. It was what KBC owned. And it also now, with Infochem multi-flash integrated with Petrosim, means we have a constant fluid basis all the way through the simulator. So that was one of the key attractions, that they already knew each other and had worked together in the past.
Lovely. Well, thank you both for joining us today, and thanks to the audience for dialing in. And we'll look forward to hearing from you going forward.
Thank you very much.